Nice to see you.
Let's talk about what you see in the economy, just in terms of commercial banking. What's happening?
Everyday economy seems to be very good right now. So we're still seeing signs of strength. We've got our customers feel good, both on the consumer and the business side. There's some pockets of concern if you're exposed, obviously, to trade or tariffs. If you have an issue that may be related to the luxury housing market, that's something that we've seen kind of pull back a little bit. But the broad indicators are very good.
What do you hear from clients when it actually comes down to tariffs?
I think that you have to break it into a couple different classes. So there are folks that need to make capital investments, and they're very reluctant to get into a situation of making a significant capital investment, that next new warehouse, that next new barge, something like that. Whereas folks that may trade a commodity or something, they're looking for alternative suppliers, and they're less impacted.
So, I mean, that's a huge issue, because we have seen capital expenditures not keeping pace with what we had anticipated, particularly given the tax changes that went into play. You think that this is part of the reason why?
There's a direct link there. I think that in everyday decisions, if you're making smaller decisions about maybe a hire or something like that, you feel good about the business in the short term, you're making those decisions. But the decision to put 10, 20, 50, $100 million into a new plant, new equipment, you really want to have some certainty about the longer-term future. And I think tariff and trade is about the longer-term future, not about the short-term.
Does it actually slow companies from capital expenditures they might be making in the United States? Because I can see, if you were thinking of building a plant in Mexico, even with the deal that's been cut this week, I can see how you'd say, forget it. I'm not doing that, because on a whim, my costs of producing things could go up by 5 to 25% in the matter of a number of weeks. But here in the United States, it feels like the economy is still doing well. Does that really slow down capital expenditures for here in New Jersey or the tri-state area? I
think it keeps capital on the sidelines, and that's the issue, where you have the ability where the economy could be growing faster, or, if you see this potential slowing in the second half of the year, we might be able to dampen or avoid that if there were a little more capital spending. But they are staying on the sidelines and saying, I don't want to make those giant investments.
So is this a situation where we have nothing to fear but fear itself? People are just afraid to do things because they don't know what's coming next?
Yeah, we could very well talk ourselves into a recession. You can get, there's a point at which sentiment will hit the consumer, and then that can fold back through the economy. So far, we're not seeing that. We have I was just with one of our clients who runs a restaurant group, and he's refreshing his restaurants. He's opening a couple new ones next year, making thoughtful, careful capital investments, and that makes a great deal of sense. But what you don't see is the very large investments that would be dependent upon trade or warehousing or transportation, those kinds of things.
What do you hear in terms of hiring from your customers? Are they having a difficult time finding people? Are they looking to hire?
Yeah, so there's a couple things coming together. First, they're having a difficult time hiring, but we're also making it much more expensive to have an employee on the books. And I think those two issues come together. So not only is it difficult for you to find your staff, but now with new work rules in New Jersey, we had new rules around leave, for example, last year, which really placed a burden on a lot of small businesses who, when they have a labor outage because people take extended leave, that can really hurt their bottom line. So they're looking at automation. I've got clients that are automating things that they would not have considered automating 2, 3, 4 years ago, because they can't find the labor, and when they can find the labor, it's just frightfully expensive.
Wow. The new tax law certainly affected some of the SALT states, the states that used to have big deductions on state and local property taxes. What have you seen? You mentioned that the luxury market has been hit a little hard. Is that a reflection of that?
The most surprising thing is that really smart people paid no attention to the law. So, we have a lot of clients who were, very thoughtful, and until they filed their tax return this year, they really hadn't done the math over how SALT would impact them. So I think although the law went into effect a while ago, they're now just understanding how much those property taxes hurt, the lack of deductibility. So we are seeing in the luxury housing market people thinking twice about getting involved in a real estate property where you're paying, some of those properties are $50,000, $100,000 a year in property taxes. If it's non-deductible and your state income tax is non-deductible, that's a big hit.
And probably going to climb for some of those luxury clients, too, in New Jersey.